Hi, I'm Mike Ward. I want to talk to you a little bit about growth in companies and the consequences of growth, and in particular about sustainable growth. So, why do we care about growth? Well, I'm just demonstrating here two companies, and I'm showing you that if company A grows at 2% and company B grows at 3%, and they start in the same place with a free cash flow, that's what that stands for, of 100, whatever the currency, and it grows at 2% for A and 3% for B, and let's assume these companies are going to keep on going for a long time. Depending on what the appropriate discount rate is, but let's not worry too much about that. You can see there is a significant difference between the value of these two companies. So for shareholders, growth is a pretty big consideration. They want companies to grow. They actually don't want to be paid dividends. As Warren Buffett once said, the payment of a dividend is an admission of management's incompetence, their inability to find new opportunities for the company. That's what shareholders really want. Bear in mind, when we talk about shareholders, we are talking mostly about pension funds. So it's true in certain parts of the world, in Europe and in Japan, actually asset managers, the size of pension funds is starting to shrink. But in emerging markets, that's not the case at all. So there's no need for dividends in general. So let's go and have a look in a little bit more detail about all of this. So if you are making coffee, let's say, and you want to make more money, which we all do, without working harder, there's certain things you can do. First of all, you could maybe cut the costs. And of course, you should try to do that. Obviously, you don't want to kind of downgrade the quality of your product or the service and so on. But so you're kind of constrained, or you could put up the price. But again, you don't want to lose customers, so it needs to be kind of balanced. So maybe you could put in less coffee and foam the milk a bit, and put an Italian cup and add some pizzazz and I don't know, call it a cappuccino or something and charge more. So one's got to work at that because that's the easiest way of making more money. No more hard work, just smart work. And that's kind of why we try to include marketing and strategy into our thinking. But eventually, to make more money, you are going to have to look at not just the pricing and the costs and the product mix of what you're doing, which is the starting point always, but you're going to actually have to make more cups of coffee. You'll have to grow the business. Now, if this is your little coffee shop here, it's great. If you grow the business, you'll be able to handle a little bit more volume in your coffee shop, but pretty soon you're going to run out of capacity with your factory or your shop or whatever business you're in. And so one's got to find ways, of course, of being more efficient in the utilization of our coffee shop. Maybe we could do takeaways. Maybe we could get people through the system faster, because if we keep growing, we're going to need more space. One thing we don't want to do is have Wi-Fi, for example. People just sit at the tables and they drink one cup of coffee. We want to get people through that coffee shop super fast. We're going to pay Techno Beat Coffee. Those guys must come in there. No Wi-Fi. They must go because we are trying to get throughput. So I'm exaggerating a bit here, but what we're trying to do is we're trying to sweat the assets as far as we can, whatever the business is, so that we do not have to invest in more assets. But inevitably, as we want to keep on making more money, we're going to need another coffee shop, another factory, whatever our business is. And the question is, where does the money come from to pay for that? Now, it sort of depends on what we've been doing with all the profits we've been making. If we pay them all out as dividends, obviously none of it's going to go there. If we retain some of the cash we've been making, then that would go towards the new coffee shop. But maybe it's not enough. So we need a bank who's going to come in and, if we put in some equity, they're going to put in some debt. And that will depend on the gearing ratio. So if the bank match what you put in, that'll be a 1-to-1 gearing ratio. Well, that'll be nice. If we can get a higher gearing ratio from the bank, well, then maybe for every one that we put in, they'll put in two. So that's kind of what we're looking at. But you can see there's several things that are important here. First of all, how profitable we are, how efficient we are in sweating our assets. We're also looking at our debt to equity ratio. Those are all components of ROE, notice. And the fourth thing, though, is what we call our dividend payout ratio. How much are we keeping and how much are we paying? So these are the things that we want to talk about when companies grow. Now, there's certain key relationships that affect growth. First of all, the profitability. So that's the pricing, costing, and product mix. The efficiency. That means fully utilize the assets, 365 days, 24 hours a day, if we can. We can open that coffee shop at night. That's great. And can we maybe speed up what we're doing? And thirdly, the dividend payout ratio. If we can retain all our profits to fund the growth, and that's what shareholders would ideally like, actually, then that's going to be our best option. Now, these three things are, as you have seen before, actually just the body of ROE. Maximizing ROE is going to, in fact, enable you to grow as fast as you could. So, and of course, gearing. We've talked a bit about that. So, companies need to plan into the long term and see what funding they are going to need. And to do that, they engage in guessing, pro forma financial statements, budgets for the next 5 years, that type of thing. And many times they do this on the basis of a kind of how fast will our sales grow at, and we link our costs and so on to our growth rate. So these are the steps that they would go through. They're going to estimate their sales growth over the next few years, forecast the cost expense ratios and so on, keep fixed costs more or less fixed, assume interest is kind of based on some numbers fixed as well. Maybe the interest expense might be fixed to start with. And any retained earnings that they make in a year obviously gets credited to the equity account on the balance sheet. You are saving it. Then they're going to start by looking at the balance sheet. They're going to have a look at their fixed assets and then the working capital, which will probably grow in relationship to sales. And then they're going to balance the balance sheet with the debt figure. So that's the kind of method in which we do. And you'll see I have some other videos which talk about that. And you can look at that. So let's focus, though, on this concept we talk about as the sustainable growth rate. What exactly is that? So first of all, it's got nothing to do with the environment and save the world and green and all of that. That in financial terms is not what we mean when we talk about sustainable growth. What we mean is it's the fastest rate that a company can grow at without asking the shareholders to put in more money. So that's what we're looking to do. We want to grow as fast as possible, but we don't want to go to the shareholders and ask for more money. We'll put in more debt, but only to keep the gearing ratio constant, what the bank will allow us to do. If the bank will allow us to take on even more debt, we might do that as well. So that's what we are talking about here. We are not suggesting that that is the right ratio. Is the sustainable growth rate the correct growth rate for a company? No, that's not what we're saying, actually. We think that companies should grow as fast as they possibly can. And the reason we say that is not just to make the shareholders more wealthy. If you were to ask the world, what is it that they want most? And in fact, the Gallup company do this from time to time. They go around with questionnaires asking people, what do you want most in life? And some people say, a girlfriend. Some say love. But the thing that comes out at the top of the list is a good job. And jobs come from companies growing, not the government. They come from companies growing. So we want growth. We desperately need jobs, especially in the world as it stands after the virus. We are going to need a lot of growth. It's going to be hard to get. So there are considerations, though, if we grow faster or slower than the sustainable growth rate. And we're going to talk a little bit about those things. So it's there. It's a kind of benchmark that we're going to use. It's a useful benchmark, actually, but it's not necessarily the rate we want to grow. Sometimes companies cannot grow that fast. Sometimes they are growing much faster than this. Sometimes they're growing more slowly. So it's just there, and it gives us some idea of what is going to happen. So let's just have a look at a very simple example. We assume we want to grow as fast as we can. We assume that we're not going to issue more shares. That's the key thing that limits sustainable growth rate. We assume that the bank have agreed some debt to equity ratio and that we have agreed a fixed dividend payout ratio. Then if this is just a little simple example that I'm showing you over here, we're going to assume that we're already profitable, we're already efficient. If we want to grow, we have to buy more assets. In other words, there's no space in our coffee shop just to keep growing. And we're going to assume that there's a ratio for gearing that the bank have agreed. And I'm just making up some numbers here, a very simple little scenario here with just three line items in the income statement. I've got revenues, the earnings after tax, and the retained earnings. And you can see the balance sheet in 3 lines as well. Doesn't get simpler than this. There's our assets, and there's our debt and equity, and you can see the capital balances with the debt to equity ratio. So for our third year, we want to kind of get a feel for what things could be. And let's just jump in and assume we are able to grow at 100%. Just pick a number. And let's go and have a look at what that balance sheet and the income statement would be like if we did that. Well, here it is. You can see on the income statement, it's pretty simple. Everything doubles. Our revenue is going to grow at 100%. The 500 will be 1,000. The profits will be from 200 to 400. And the retained earnings are going to be 50% because they were 50% in the year before. We're keeping, remember, that the dividend payout ratio is constant. So if it was paying out half your money like we did in 2016, we're going to do the same in 2017. But look at the balance sheet. You can see that we've had to, first of all, grow our assets also by 100%. So they've doubled. Why is that? Because we were at capacity. We assume that if you want to double, your sales, you need another coffee shop or another factory. And that may not be the case, but in this example, I'm just making that assumption. But look at what's happened to the financing. You see the equity went from 600 to 800. How do I know that? Well, because all we got was the dividends. Sorry, not the dividends, the retained earnings. The dividends were paid out. Half was the dividends, the same amount actually. But so just the 200 in retained earnings was added to the 600. That takes us up to 800. So the debt must have gone from 400 up to 1,200. Why? Because it has to balance the balance sheet. And so that's a problem. If you look at the debt to equity ratio in 2016, you can see it was 4 divided by 6, which is 0.67. And now it's 1.5. So we've got a huge problem. No bank is going to allow that. So 100% is just growing too fast. If we were to do all of this again at a much lower growth rate, let's do it at 10% growth, you're going to see something different. First of all, look at the revenue. It's grown by 10% from 500 to 550. Same with earnings. And half of those earnings we are going to retain. And look at the balance sheet. The assets have grown by 10%. We don't have capacity, remember, in our existing facilities. So that's 1,100. The equity has grown to 710. That's because we are retaining 110 from the income statement at the end of the year. And so to balance the balance sheet, we actually are paying off some debt. And if you do the ratios, you can see our debt to equity ratio, which was 0.67, is now 0.55. It's too low. We could have grown faster than 10%. So somewhere between 10% and 100%, there is a magic growth rate, and we call that the sustainable growth rate. Now, it seems like, we'd have to do this by trial and error, but actually it's a very simple little calculation that gives you the sustainable growth rate for a company. All you do is you take the retained earnings in the last year and you divide it by what we call the opening equity, what you started the previous year at, 2016 year at, which is the ending of the 2015 year. So if you take 100 and you divide it by 500, you get the sustainable growth rate happens to be 20% in this example. Now you can see if revenues grow 20% and earnings grow 20% and we pay out half, that gives us retained earnings of 120. Look what happens to our net assets. They've also grown by 20%. That's correct. Our equity has grown from 600 to 720 because we're retaining the 120. And our debt to balance the balance sheet is sitting at 480. And if you work out the gearing, you can see it is exactly right. So it's easy to work out the sustainable growth rate for a company. You just take the retained earnings and you divide it by last year's equity, and you're going to get it. Now, that may vary from year to year. We could take an average, say, of the last couple of years, but it's a very useful number. If you're going to analyze the performance of a company, you're going to work out ROE and the profit margin and the efficiency and the gearing ratios and maybe a few others, but pretty soon you should work out the sustainable growth rate. Let's say it comes out as 20% like we've done over here. You then compare that to the actual growth rate that the company is growing at. If it's growing at 40%, which is not bad, by the way, that's good. It just means that that company is not going to have enough money within its own means to fund the growth of the business. And we would like to see where it's getting the money from. Is it issuing more shares? Is it taking on more debt? Because something is having to give. If it's the other way around, and sometimes it is, the sustainable growth rate is 20%, but they're only growing at 10%, then you'd expect to see a lot of cash in the business because they're not using it for growth. But actually what you tend to find is not cash sitting around, you find luxury. They are now upgrading the carpets and the fish pond and the offices and going off to Mahi for their strategy retreats and whatever. And one's got to come and cut some of that wasted expenditure. So it's a useful number. It gives you a guidance as to what is happening with the business. Now, I've written down the formula here. This is how we work it out. To get the sustainable growth rate, take retained earnings, divide by opening equity. But you can also work it out in terms of ROE. And since I am a great fan of ROE in the DuPont model, I wanted to show you how that works. So if you take ROE and you multiply it by the retention ratio, and I'm not going to prove this mathematically, you're going to get the sustainable growth rate. Now, if you look at that formula there, the retention ratio is just the inverse of the dividend payout ratio. So if the dividend payout ratio is 50%, then the retention ratio is 50%. If you're paying out 80% of profits, the retention ratio is 20%. Now, you can see from that formula that the maximum the retention ratio can ever be is 100%. That means no dividend. And the sustainable growth rate will be maxed out at ROE. It can't get higher than that. So ROE sets the limit for a company's sustainable growth rate. If it wants to grow faster than that, it will have to source more capital or become more efficient, or something is going to give. If the retention ratio is 0, that means it's paying out 100% of its profits as cash. The payout ratio must therefore be 100%. And it's not rocket science to know that if you're paying out every cent that you make, you can't grow. So you can sort of see that this gives us quite a nice way of understanding stuff. And, when we introduce the DuPont formula for ROE, we show you that the three things which drive ROE are the profit margin, that's the net profit margin, times activity, or the net asset turnover ratio. Those two together give you RONA. And if you multiply that by the leverage in the form of the equity multiplier, you get ROE. What I'm doing is I'm just adding a fourth leg to this now. If you multiply ROE by the retention ratio, you get the sustainable growth rate. So it's a very nice kind of way of understanding businesses. If you get this in your head, it will help a lot in terms of looking at a company and analyzing what is happening. So here's a little example here. You can see this company is it's forecasting a sales growth of 25% for next year. And its financial history summarized in the table below. You can see that the bank have indicated they are unwilling to further extend their lending to this company comment on the situation they find themselves in, and what would you recommend? And then you can see we've given you the breakdown of all of those ratios. There's the profit margin, the efficiency, the asset turnover, the gearing in the form of the equity multiplier, and the retention ratio. And you can see, if you look at the first column, if you take the profit margin times the asset turnover times the financial leverage, those three numbers, 5 times 3.5 times 1.6, you are going to get 28%, which is maths. If you multiply the 28% by 0.5, which is the retention ratio, you're going to get half of that, which is 14%. And you can see, if you just look at these numbers, look at the financial leverage ratios across the last 4 years. You can see they're growing bigger and bigger, 1.6, 1.8, 2.05, 2.2, and the bank are saying, no more. We are not going to continue to stick in our money into this company. So how are you going to fix this? What would you do? Well, the one obvious thing to do is to cut the dividend and to increase the retention ratio to 100%. Let's retain all the money. Let's not pay the shareholders because we need the money. Now, shareholders are not going to like that, actually, because they've learned over the years that you haven't really fixed the company when you do that. You're just like treating symptoms, like going to the doctor, and they just give you a Panado. And so it's not really a good fix. Sometimes it's necessary, but you probably need to do more than that. And in this case, if you look at the last year, 2016 there, you can see that even if you were to cut the retention ratio, increase the retention ratio to 100%, then ROE would be the limiting would be equal to your sustainable growth rate, or the other way around. Your sustainable growth rate would be 17.2%. But you can see they want to grow at 25%. So it will help, but it's not enough. So you can see the obvious problem with this company. You could, of course, ask the shareholders for more money. Please, will you put in more money? And but you know, the shareholders are going to be looking at this, looking at ROE and seeing, gee, it's going 28, 27, 20, 17. Where's it going? 15, 10, 5, 0. They're not going to put any money into this company. If it were going the other way around, if we were going 17, 20, 27, 28, then they would say, please take our money. But it's not. So the real issue is in the top line. You can see it there. Look at the profit margin. It is more than halved over the last 4 years. Now, I've often seen this kind of problem. And what's happening here is this company is probably, we need to ask more questions, probably been run by the sales manager. And all they're doing is setting bigger and bigger targets. You can see that the growth rate has gone from 17 to 20 to 21. And now what are they targeting? 25. Why? Because 25 is more than 21 and we must stretch people. Very dangerous. Very dangerous. There must be a reason, a way in which you can grow. You need to understand growth more than just saying hit the number. Because especially if you link bonuses and performance, rewards to hitting a number, people will do it. And it looks to me like they're either cutting the price or else spending too much on marketing and promotion because the margin's going down. We need to actually put up the prices. What will that do? Well, it's going to slow down the growth. But actually, it's better to slow down the growth and necessary to slow down the growth. And at least we are growing, let's put it that way, so that ROE can come right. ROE is more important than growth. At least it is in the long term. For short term, maybe you want to build on growth, but you can't do that forever. So I'll end with this. You see, if we are to plot like a matrix of growth versus profitability on our two axes over here, you can see the really best place to be is in the top right quadrant. Great company, growing fast, lots of ROE. They are great companies to be in. But not every company is there. Second best would probably be bottom right, where we've got not enough profitability. ROE is low, but we've got growth. Then what we can do is we can increase our prices. It'll cause us to slow down, and that'll take us into the good enough quadrant, top left. we can be happy there. We're not growing fast, but we're at least giving shareholders a reasonable return. We're not asking for excessive returns here, but a reasonable return. Otherwise, they're going to change management or sell their shares. The real problem is the companies sitting in the bottom left quadrant. And I'm calling those the restructure companies. That's the group of restructuring companies. And that's a whole separate topic. And boy, it's a really big topic now that the virus has hit, because actually a lot of companies are sitting in there. And it's quite hard to do that. And it's quite tough to do that. To restructure companies, we use nice words. We talk about right sizing and operational restructuring. We've got these words. Actually, it means we're going to fire people. We're going to close down divisions. We're going to sell off assets. And we have to be quite aggressive when we do that, because you only get one shot, mostly. To keep going back and, it's death by 1,000 cuts type of stuff doesn't work with us. You really have to come in there, fix that company once, good and proper, get rid of the excess debt, not death, debt. And it's not a nice place to be. So I hope you found that interesting. Thank you.